process, and I'm not sure when that application is actually done, completed, and finished. This isn't like college. And also, the other concern that I had was, well, let's assume that I am waiting for entitlements, and then I get it on the first day of the 36th month. Does my time period then end that day? That is, I was waiting for that action. That action occurred. Now I got it. Now presumably I'm entitled to build something, but I haven't built it yet. So to me, in some respects, that relief valve was a trap. I'll do my Admiral Akbar imitation when people throw it at me, that it's a trap. I just don't see it really, at least in my part of the world in San Diego. I don't see that being much of a relief valve for us, because I don't think, realistically, if we were waiting for a certificate of occupancy, I get it. We get it, we can open the doors, the tenant can come in the next day. But that's not where the holdups are.
So you want to give that one back then, Phil?
No. I want people to be careful on relying on it, because I'm not sure, at least in kind of my part of the swamp, I'm not sure it means very much.
It's about mitigating risk. This is another risk factor that you've got to understand as a developer. It's vague language. It's open to interpretation by an IRS agent and under audit. It's not defined. I think that you don't want to count on this. You probably want to shrink that timeline as much as possible, and you probably want to avoid putting yourself in a situation where you have to defend this under development.
Steve, what happens if I'm waiting for the clock to run out on a 1031 exchange? Maybe I identified some property. It appears now I'm not going to get it, and I've decided I want to do an opportunity zone deal. You touched on this a little bit earlier. Is there anything else that I need to be thinking about or telling my investors there?
Well, I mean, I do. Look, unless you're unbelievably wealthy, you got to find some way to get that cash for your OZ investment, and you probably got it parked with a QI. So you do really have to watch your timeline on when the 180-day is up on the 1031, and when you're going to be able to get that cash to make your OZ investment. Query, what if it happens, what if you start the clock on the same day? How are you going to manage both of those clocks? Candidly, I'm not sure I know how you do that. I think at the end of the day, you have the wire go from the QI over to your fund on that day. And that's the best I can do.
Okay. All right. So you're not going to advise everybody to set up funds in Hawaii? So they're 3 hours ahead in terms of
that would be a West Coast solution, not an East Coast solution.
That's a Daryl Steinhaus solution. Okay. Yeah, set up the bank accounts all in Hawaii. Yeah. So you get a few extra hours to get the money in. All right, let's talk a little bit about compliance issues. I'd like to, starting with Paul, kind of hear from our developer. I mean, in some respects, compliance issues, we lawyers, we think about things particular ways, whether that's right or wrong. But I'd like to hear from our developers in terms of how they perceive the compliance obligations that exist here in the opportunity zone that don't exist in other types or other forms of investment, typical new money investment. Paul, do you have a feeling about either the compliance side or the decision-making process? If we're going to buy a property, are we committed to it for 10 years? Are we going to look at taking it to market? And if so, what are the consequences of taking it to market before we hit a 10-year hold? What if some of our investors are in for 10 and some aren't? Kind of, how do you look at those decision-making processes from a developer side?
Yeah, so I mean, I think if you're selling an asset right now, you love it because everybody puts OZ zone on their marketing materials and hope that it moves the needle, and maybe it does. When you're buying and forming capital, I mean, when you look at development deals, the metric you all use is return on cost. And we're going to underwrite return on cost the same way we would in any market, and in these markets probably a higher return on cost. And the jury's out on whether this new form of capital is going to compress cap rates and return on costs or not, or if people are going to be conservative, as you pointed out. One thing we hate in our world of being a developer or managing capital is to have a gun to your head, because we have 5 projects right now in California at various stages of entitlement. And they always take longer, and things happen. And then, of course, between entitlement and breaking ground, you got to get your CDs done, and you got your construction financing lined up and the market can move. And in every one of our cases, we've got cash flowing assets sitting on our land today. So we don't have a gun to our head. So the timelines concern us a lot. We're still struggling with it. We've got one project in Hollywood that we're considering, using OZ money, and we're considering raising OZ money around it because we've come from an institutional background of managing capital. But the timelines are a big concern, and especially when, again, back to my earlier point, we are at an end cycle, and raw land or covered land plays with a little bit of cash flow are terribly liquid as soon as we have a problem. And your construction loan could vanish tomorrow, and then you'd have a gun to your head, which would be bad because now you're not preserving taxes, you're actually losing your capital. So you've sort of shot yourself in the foot. So we're still struggling with that a little bit, frankly, and I think a lot of people are here to understand what the rules are, and the regs have been out a week, and we're expecting the lawyers to know everything.
Yeah, well, service provider, believe me, they started calling an hour after they were out. I mean, literally it hit 10:59. By noon, I already had a phone call saying, so explain it to me. Dan, why don't you talk a little bit about it from the compliance side, and then you and I had a little offline conversation in terms of different alternatives to deal with a liquidity problem from the standpoint that your investors are going to have to pay tax on the gain of the assets that they sold to put in the Opportunity Zone Fund in December 31, 2026.
Right, so if this is a 10-year hold, which is probably where you maximize your tax benefits here, well, there's a really good chance and a high probability that that's going to be well after the date that this original capital gain is due. So, as a good steward of capital, I think it's important to have these discussions with your investors up front, so that they have a way to pay these taxes when they're due, even though the equity may be in a partnership or in a development for several more years. There's a couple ways to do that. You can refinance out of these projects or bring some, get some capital out of these projects to help your investors pay their capital gain in 2026. I don't know if depending on what interest rates are going to be in 2026, if that's going to be a viable option or not. If it's an unsophisticated investor, that you may want to talk to them about escrowing some of their cash flows. Put it in an escrow account so they can, in 2026, tap into those funds to pay this liability. But ultimately, it's the investor's obligation to be prepared for this event. But if we're accepting this capital, I think as a developer and a good steward of capital, you should be aware of the situation and certainly be able to refer them to a professional tax attorney or somebody where they can be prepared for this. So it's not just a last minute event.
Okay. On our end with hospitality, we're looking at 2-year timeframe deals, maybe a little bit longer, but still a shorter timeframe in the ground up space with our developments and substantial improvements, and we're generating that cash flow right thereafter. So by the time that with the cash flow that we're projecting, for example, in the one in Fort Lauderdale, we're hitting that 8 to 12% range, and even if it's slightly lower, I think you accumulate enough to be able to pay, and that's kind of our message to investors, that it's not just a potential refi, that you're going to be getting enough cash flow from the assets to be able to offset that payment that you're going to have.
Okay, last point on the compliance side, substantially all. It's one word that seems to have many definitions.
It's 2 words.
Well, it's 2 words, but it seems to have at least 5 different definitions.
7 different rules.
Seven, yes, depending on where you look and what you're applying it to. So, Steve, why don't you walk us through with the meaning of substantially all?
So we found out back in last year's regs that substantially all is a test that we can apply to the project partnership. Usually in these real estate deals, right? We're going to own the project down in a partnership below the fund. At that level, we're going to test whether or not we have good assets, right? And the good assets have to be what? Qualified opportunity zone business property. 70% of your tangible property needs to be that. That's substantially all. That's what the regs told us. The substantially all definition was used in lots of other places, and we got some more definition on that coming out in the April regs. And those regs told us what? That when we're talking about use, 70% of the use has to be in a zone. Well, with real estate, who cares, right? It's already there. But the other one was, how long does something need to comply with that? So if you're looking at the partnership down below, how long does that thing need to comply? 90% of its life, the partnership interest has to be in a qualified opportunity zone business. Gives you a little leeway in thinking about things you might be able to do. Nobody's really started to explore that yet, but there might be some leeway in a 10-year deal of having 1 year where you're not quite doing it by the book. But there's the other part of substantially all that these new regs spoke to. You know, we kind of knew what was going on with owned property and where the issues were on substantially all, right? So usually on the real estate projects, we have with some sense where things were going, but the hot spots were what? Purchases from related parties. They were hot spots with contributed property. And so those were a couple places where we knew there were issues, or property that was already owned before 2018. These new regs also brought about some clarity on when leased property was good. So let's just run through that real quick. Leased property is good for this 70% substantially all test, right? If the lease is entered into after 17, it can be from a related party. We already talked about that. You don't have an original use or substantial improvement requirement. So Dan was alluding to the fact that, hey, we may have a new tool here, and we do. It's got to be a market rate lease. And if it's from a related party, you can't have prepaid rent. The kicker here is you got to value that lease. So if the lease is on your financial statements and a carrying value under GAAP, you can use that for your 70% test. Okay? If it's not, if you're using if you don't have GAAP, then you're going to do a net present value of the lease stream, and that's how you're going to measure it as to whether or not you're going to satisfy this test. Now, one other thing just to mention kind of quickly is, you know, land has always been wonky here because it's not really under the theology of these regs. It's not something that gets used, appreciated, etc. So where does it fit into this whole question about this substantially all test? At the bottom, what these regs end up saying, right, was anti-abuse. They did not give you a rule that you have to spend a certain amount for it to work. But what they did say are two things. One, don't land bank. Don't kid us, don't land bank. Second one is, don't push it too far. It's just an anti-abuse rule. There's not going to be definition around that. The example they used was a farm. A farm is property that is being used in a trade or business, but damn, it's not what the program was designed to do. So that land is still in that sort of be careful zone, no hard rules on that. Interesting thing from all of this, one of the takeaways is that, we can start to use these leases, ground leases, on solving problems and taking property that was already owned before 2018 or is owned by a related party, somebody owns too much, and trying to get it into a fund. Exactly how to do that and make it financeable, still work to be done, but there is a new tool that we can use. Last thing I will say is that on the compliance side, Phil, if you're representing this, looking at this from an investor's perspective, particularly in a syndicated deal where you don't have much control, I think you do want to sort of be pushing pretty hard for regular quarterly reporting from somebody other than the sponsor. Just tell me that I'm good every quarter.
Right, you're right. Some type of independent verification, whether it's a CPA firm, accounting firm, somebody else, but somebody who's going to come in and look at the historic use of capital and if it's needless to say, if it's a business, kind of what's going on in the business, because the business rules I think are much harder to comply with than the real estate rules. Let's talk a little bit about disposition. So we've done our work. We're getting down to the end. Maybe we've held it for 10 years. Maybe we haven't. What are some of the issues or concerns that we're going to have if, for example, we have a multi-asset fund, Steve?
So the good news is the service treasury gave us regs on how to deal with the exit, right? So we now know that you can have a sale of assets as long as it's qualified opportunity zone property, and have that eliminated on an individual partner's tax return, so long as it flowed through on a day one and he held it for 10 years. That's good. So the big concern about multiple asset funds has been alleviated. It's not a total solution. There's still some concerns out there about things like ordinary income when you sell, because that doesn't get covered under this new rule. The new rule also doesn't quite say that it applies down at the partnership level. So there still is a little bit of fuzziness. What do we hear from the service? Basically, they're not going to let this be a big problem. I will say there still is tax benefit of having the investor sell its interest, but how do you do a real estate sale where the investor is selling his interest? Take some creative structuring to do that.
Right. So let's move down the line. Let's hear from our developer side. The issues that come up are what they're thinking about in terms of the ultimate exit, the ultimate disposition of an asset in the opportunity zone. So Dan, let's get some input from you.
Ideally for us, it's to hold it for the full 10 years, so everybody benefits from the full tax treatment, and maybe an exit year 11, year 12, somewhere thereafter. I think there's a couple different ways to exit. Certainly on ground leases, you can also exit sooner as long as you roll those gains into another qualified investment. So that's always an opportunity. You can also 1031 out of these. You can 1031. The negatives of that is that you're rolling everything, all your profit into the next deal. So I've never liked 1031s because of that scenario. One of the benefits of the opportunity zone law is that you can take some of your chips off the table. You don't have to roll the entire principal back into another deal. You can take some of your profit. It gives you more flexibility over that process. I think there's pros and cons to both, but it's up to the individual investor as far as what's best for them and their tax planning.
Okay. Paul, what about you guys on the exit side, getting out of the property?
Well, I think we're not quite there yet. I think when I think about multi-asset funds and it's this